You didn't click this video by accident. You clicked it because you're tired of guessing, tired of hype, and tired of watching people earn while you hesitate. And in 2026, hesitation is going to be expensive. The market is entering a phase where the slow learners get punished and the early learners get rewarded. You chose the right side. So here's the plan. We're going to break down the most common beginner mistakes people make in 2026, why they happen, and how to avoid them, even if you're starting with a small amount. Nothing overwhelming, nothing confusing, just clear, grounded ideas you can actually use. Keep this in mind for a second, because what happens next connects everything in a way most beginners never notice. The first mistake beginners make in 2026 is assuming the market will keep behaving like it did in 2021 to 2023. That mindset creates a trap. People think stocks only go one way. They think dips are temporary gifts from the universe. They think percentages like 30% or 50% returns are normal. But here's the truth. 2026 is shaping up to be a more selective, fundamentals-driven year. The era of blind optimism is fading. Companies are being priced more realistically again. And honestly, that's a good thing. Here's where most people go wrong. They jump into the market thinking momentum is enough. They buy whatever is trending, whatever someone bragged about on Instagram, or whatever a creator made a "this stock will explode" video about. But the surprising truth is that the stocks that tend to do the best in recalibration years are not the loudest ones. It's the steady, boring, proven businesses that quietly outperform. Think about a friend who started investing a couple of years ago. He bought flashy tech names, watched them soar, felt brilliant, and then watched them come right back down. He didn't buy bad companies, he just bought them at unrealistic valuations. What he missed was the calm, slow, long-term approach. So how do you apply this? In 2026, start building your portfolio around businesses that generate real cash, dominate real industries, and have the ability to survive interest rate changes. A balanced mix of index funds and reliable blue-chip stocks gives you stability that hype stocks can't. This will make even more sense in a moment. But let's move to the next big mistake beginners make. The second mistake is failing to understand risk. Not in the dramatic, you might lose everything sense, but in the simple, you might act emotionally and sabotage yourself sense. Most people don't blow up their portfolios because the market fell. They blow it up because they panicked when the market fell. Now this next part ties everything together. Emotional investing usually comes from not having a plan. If you don't know why you bought something, you won't know why you should hold it when it drops. If you don't know how much risk is appropriate for you, you'll either take too much or too little. The truth is, 2026 will be a year with pockets of volatility. Not chaos, but enough movement to make beginners question every decision. And when you don't have a plan, those movements feel personal. They make you react. Picture someone checking their portfolio 15 times a day. The moment a stock drops, their heartbeat spikes. They feel like they're doing something wrong. They start Googling things like, is the market crashing? Or, should I sell? But the practical move is much simpler. Create a set of rules for yourself. Decide what percentage of your portfolio you want in index funds, what percentage in blue chips, maybe a small portion in growth. Stick to it and review quarterly, not hourly. Before we move on, there's one thing most people overlook. Understanding risk isn't about being conservative. It's about being prepared. If you know what risk you're taking, you stop treating every dip like a disaster. Let's shift into the third big mistake. And this one is huge in 2026. Beginners in 2026 often chase the perfect entry point. They want the perfect dip, the perfect timing, the perfect moment when the market is low and their favorite stock is magically cheap. But here's the truth. Waiting for perfect timing usually means no timing. You don't invest at all. The surprising truth is that the best investors don't find perfect entries. They create consistent entries. They use dollar cost averaging, investing a fixed amount every month without worrying whether the market is high or low. So, how do you apply this in 2026? Start with whatever amount you can commit monthly. Even $50 or $100 is enough to build discipline. Over time, that small behavior becomes your biggest advantage. The fourth mistake is ignoring diversification. And I get it. Diversification sounds boring. It sounds like something your finance teacher said once and you never thought about again. But in 2026, this becomes critical. The market is shifting into an environment where certain sectors will outperform massively, while others might lag. If you throw all your money into one theme, you expose yourself to unnecessary risk. Here's the myth. People think diversification means owning a bunch of random stocks. But the truth is smarter than that. Diversification means owning assets that behave differently from each other. A tech stock and another tech stock aren't diversification. A tech stock and a consumer goods stock? Much closer. A mix of index funds plus a few sector ETFs? Even better. Let me tell you about someone who bought only renewable energy stocks in 2021, thinking the world was changing overnight. And, yes, the world was changing, but markets don't move in straight lines. When those stocks cooled off, his entire portfolio dropped at the same time. He wasn't wrong about the future. He was just early and concentrated. A simple way to apply diversification in 2026 is to anchor your portfolio with broad market index funds like the S&P 500 or total market funds. Add in a sprinkle of sectors you believe in, but don't go all in on the future. Spread your exposure. You protect yourself from being early, wrong, or unlucky. The fifth mistake beginners make, and this one is becoming more dangerous every year, is treating investing like entertainment. Social media has blurred the line between financial education and financial entertainment. People watch high-energy creators making bold predictions, and they assume confidence equals accuracy. In 2026, this mindset will be even more destructive because the market is entering a reality check phase where fundamentals matter more than vibes. Think about it. Most creators online aren't actually investing experts. They're entertainers. Their goal is to be interesting, dramatic, or controversial because that's what gets clicks. And beginners confuse entertainment with expertise. They follow the loudest voice instead of the smartest one. They chase top 5 stocks to buy this week, like recipes, without knowing anything about the underlying businesses. The danger isn't that creators are wrong. The danger is that beginners copy ideas without context. And when the market turns, they don't know why they invested, so they don't know what to do next. There's a guy I know who bought 5 stocks simply because his favorite TikTok creator said they were future multi-baggers. And, to be fair, the creator sounded intelligent. But when those stocks dipped, he froze. He couldn't explain what those companies did. He couldn't explain why they dropped. He couldn't explain whether the drop was temporary or structural. He ended up selling everything at a loss, not because the companies were bad, but because he didn't understand them. The practical lesson? Use social media for ideas, not decisions. If someone mentions a stock, research it yourself. Look at revenue, earnings, debt, competition, and long-term potential. If you can't explain why you bought something in one simple sentence, you probably shouldn't buy it. The sixth mistake beginners make in 2026 is overestimating short-term gains and underestimating long-term compounding. Beginners want results fast. They want their first investment to double. They want to feel something. But investing doesn't reward impatience, it punishes it. The real magic happens when your money compounds quietly in the background for years. In 2026, this problem gets amplified because the market will likely have periods of sideways movement, not crashing, not booming, just drifting. And beginners will panic thinking, nothing's happening, maybe investing isn't for me. But sideways markets are historically the best time to accumulate shares quietly before the next big cycle. And here's the surprising truth. The best long-term returns often come from the most boring months. The seventh big mistake? Not understanding taxes. Yes, it sounds boring. Yes, most beginners ignore it. But in 2026, tax efficiency becomes a bigger deal because more platforms are offering taxable accounts with fewer guardrails. Beginners might buy and sell frequently, not realizing that every sale could trigger taxes. Even profitable decisions can become expensive if done without tax awareness. Imagine someone making $300 profit in a trade, feeling smart, and then owing $120 in taxes because they didn't plan. It's not the trade that hurts them, it's the lack of information. Long-term holding is naturally tax efficient. Index funds are naturally tax efficient. Mindful investing gives you more money because you lose less to unnecessary taxes. 2026 will be full of new financial products that look advanced, but are just fees wrapped in marketing. Beginners who stick to simple, proven tools, index funds, ETF, blue chip stocks, long-term positions, will outperform the noisemakers without trying. Another overlooked mistake in 2026 is comparing your portfolio to others. Comparison kills clarity. Someone on Reddit might post insane gains. Someone on YouTube might claim they made $40,000 in a month. Someone on Twitter might brag about 300% returns. Beginners think they're behind, when in reality, most of those claims are exaggerated, cherry-picked, or involve insane risk. Everything we've covered leads to one simple truth. Beginners fail in 2026 not because the market is dangerous, but because their mindset is unprepared. They want fast wins, they want perfect timing, they want guarantees, but investing doesn't reward perfection. It rewards consistency, discipline, patience, and understanding. Once you see this final piece, the whole strategy clicks. Investing is not about predicting the future, it's about preparing for it. Subscribe for more insights like this.